You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
You're a confident guy, John. The consumer confidence number just came out from a conference board. Man, spot right on the forecast. Wow. Came in at 114.8. That was right in line with expectations. And notably, it was a lot higher than last month, which was revised down to 108. So nice pickup there. Let's break it down with somebody who kind of knows what's happening here. Dana Peterson, chief economist at the conference board, joins us via Zoom. Dana, it looks like a solid number. Put it in context for us.
Absolutely. We have the highest reading on consumer confidence in 2 years. A lot of it was led by the present situation where consumers are feeling good about their jobs, they're feeling good about the business situation, but also consumers are thinking that maybe we won't have a recession. And that also contributed to expectations which were above that threshold that usually signals recession.
Yeah, before you came on, Dana, we did the JOLTS job opening survey. More evidence the labor market is just cooking along. How much does that play into this?
We think it plays a huge role. Consumers continue to say that the labor market is good. Even most of last year, they said the present situation was fine with regards to the labor market. Many of them are working. Companies are not letting people go because they're concerned about labor shortages. And so that's been benefiting the consumer and definitely supporting their finances and their incomes.
And Dana, it's interesting here. We're getting, as interest rates come down, like just take the mortgage rate. Mortgage rates are coming down off their peak. They're still a lot higher than probably people would like, though. But everybody's got a job but wants one. Where are you looking at this economy to get a sense of really where it is and where it might be going here?
Sure. So, you have to look at the economy, look under the hood. So there are definitely areas of weakness. The housing market is still pretty weak as mortgage rates have come off, but they're still much higher, almost double what we saw pre-pandemic or even during the worst of the pandemic. Businesses are not investing that much, and we don't think government is going to be as big of a stimulator. But when you look at consumers, many of them are working, as we said. Their real incomes are rising as inflation is falling. And so that's definitely propping up spending. But the key issue is, can they continue to do so? And we're not sure about that given the amount of debt that's being piled up right now.
Okay, and these numbers also, to some extent, because they are good numbers, might actually be inflationary. You did mention consumer spending, right?
Well, the interesting thing is that in the write-ins, consumers continue to complain about inflation and prices. So the price level is high, even though inflation prices aren't rising as quickly as they were. But the good news is that inflation expectations continue to fall in our measure, and that's a signal that consumers are thinking that inflation is going to continue to decline. And so it might not be inflationary, despite the fact that we have seen some pretty strong consumption, especially in the second half of last year and in the last 2 months of last year.
Can you explain why those inflation expectations are important? Do they tend to be sort of self-fulfilling prophecies?
Well, it can be. If inflation expectations are too high, then people say, well, I'm just not going to spend because I can't afford it, and I probably won't be able to afford things in the future. So with the expectations falling, that means consumers are thinking, oh, I'm going to get some relief later on. So that means I don't have to put my life on hold while I watch prices rise even faster.
So, Dana, at the conference board, are you guys thinking there's going to be a recession in 2024 or not? How do you think about that?
Well, we do think the likelihood of a soft landing has definitely increased, but there's still risks out there that you could have a recession. It's probably going to be short. It's probably going to be shallow. Why do we think that? Again, consumers no longer have the massive supports from the stimulus checks. Also, many consumers are financing their purchases with debt. At some point, that's going to come due and they have to pay it back. We also think that some businesses may come under pressure and start letting people go, and that will definitely put a dent in confidence and also spending. But the key thing is the labor market. If the labor market doesn't weaken much further, then you're probably going to see people continue to spend, and we'll have that soft landing that the Fed is hoping for.
Are all the consumers created equal, or do you break this down into certain groups geographically or income-wise?
Yes, we do. And in fact, every income group, with the exception of the wealthiest group, were more optimistic in January. So that's definitely good news. Not sure what's going on with the wealthier folks.
They're
But
wealthier.
certainly, but the thing is that for the most part, consumers expect interest rates to be lower and they expect the stock market to be higher going forward. So, the folks who tend to have stocks are the wealthier folks. But the point is that every age group was feeling better in the month. So for the most part, consumers are much more optimistic now than they were a few months ago.
Can I just real quick, the political implications? What does it mean for a Joe Biden presidency?
Well, I will say the election is months away, and that's kind of like an eternity, right, in terms of political terms. But, the key thing is, it's probably going to be domestic issues and things like the border and spending that may cause consumers to come out there and vote one way or the other. But certainly if, the economy does take a bit of a swoon, we think it's going to be in the middle of this year. And by the time we get to the election season, the economy should be recovering. And that's good for either candidate, really.
All right, Dana, thank you so much. We appreciate that. Dana Peterson at the Conference Board.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
In addition to all the economic data we have this week, in addition to all the earnings we have this week from some big tech companies, we also have a Federal Reserve meeting tomorrow. And I think I saw Michael McKee with his bag heading down to the Acela station.
Well, there's a Michael Barr on the Fed, too. He's just
I know, exactly. We're all
not
over the
one
place.
you were thinking of.
No, exactly. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey joins us from Princeton, New Jersey via Zoom. So, Ira, I guess tomorrow, obviously the rate, any movement in the rates is not expected tomorrow. What are you looking for in tomorrow's release and in the commentary from Fed Chairman Jay Powell?
Yeah, tomorrow's going to be a very busy day for those of us in rates land. We not only have that Fed meeting, but also the quarterly refunding announcement from the Treasury Department in the morning before that. So at the Fed, we're going to be listening for nuance. I think the statement probably doesn't change very much. But Jay Powell, I think, will probably need to guide the market as to whether or not they think there's going to be a cut in March or not. He's going to probably say every meeting is live, but at the same time, some meetings are more live than others, I would say. So I think that if the Fed is thinking about cutting in March, he really has to make that not abundantly clear, but I think he has to make it a little bit more clear that they're going to be cutting in March. The other thing that I think that to listen for Jay Powell is what's the path thereafter. So the market is not pricing for what Governor Waller mentioned a week and a half ago or so, which is we're not going to necessarily go at every meeting. We're going to go slow. We might only cut 3 times this year. The market doesn't believe that they're going to do that. The market thinks that the Fed going slow is cutting 25 basis points every meeting once they start. And so it's going to be hard maybe to jawbone that, but I think Jay Powell will try to tomorrow.
What's the big worry at the Fed? Some sort of, Arthur Burns bumble? You cut now and then inflation comes roaring back and you look like a moron?
I think that's part of it. I think that the other issue that the Fed has is as they try to calibrate the Fed funds rate is there's a feeling among a lot of economists and I think a lot of people at the Federal Reserve that as inflation comes down, you have the real Fed funds rate, so the Fed funds rate after adjusting for inflation continues to rise, and that will be too restrictive and tighten financial conditions. But I think the bigger issue that the Fed has right now is that financial conditions, instead of being tighter, even though that real Fed funds rate has been going up, they've actually been easing. So you have credit spreads that are very tight. You have consumer lending rates that, while they're much higher than they were, they've come down significantly from their peak. And in large part, that's because the market is expecting the Federal Reserve to cut interest rates very aggressively starting in May and then continuing to cut into 2025. And that's adjusted a lot of the different borrowing rates and a lot of the other things that go into different financial conditions measures. And because of that, that's one reason why I think that the Fed wants to say, okay, we're going to go slow because they don't want to ease financial conditions even more. and have another inflationary impulse. So like you said, John, like that's really the fear that the Fed has, is that they might be the cause of yet more inflation in the future, and that the job's not done. And you're going to hear that again, that the job's not quite done, but we're happy with the progress made so far. That's going to be probably the opening line from Jay Powell when he talks about monetary policy and inflation.
Hey, Ira, earlier this morning we had Claudia Sahm on, Sahm Consulting and formerly the Fed. She says the Fed's already too late. They should have already started cutting rates. Is that widely held out there, or how do you think about that?
Yeah, there are some people who certainly, and some investors who think that they should be, just because the economy has slowed significantly, and you have seen that that gap widen between inflation and the Fed funds rate. But then there's a whole slew of others who look at the real economy and look at what happened with retail sales. You had the JOLTS data that was just out a couple of minutes ago that showed that job openings actually increased in December. The quits rate, though, kept on falling. So I think that there was kind of a mixed picture there in terms of the job market from that reading. But nonetheless, the economy seems to be holding up decently right now. So again, like if the Federal Reserve is behind the curve, as Ms. Sahm suggested, then certainly we don't see that in the hard data. We do see it in other things, like some of the survey data. But again, like you just had on Dana from the Conference Board, the Conference Board survey of consumer confidence was decent today. So again, there's all these mixed signals right now. Mixed signals usually do lead to a turn in the economy, but it's much slower this time than you might have expected it during prior cycles. And I think a large part of that is we still have a big fiscal impulse, right? We still have deficits that are going to be approaching $2 trillion this fiscal year and over the next couple of fiscal years. So that will keep the economy a little bit more robust than it would be normally. And then secondly, you still have consumers that don't have any lack of appetite to spend. So I think that there's a lot of good things still going on in the economy that are going to delay, I think, a recession and a major downturn until much later this year, and maybe even into 2025.
All right, you brought up fiscal, Iris, so let's talk about the Treasury cut. What did they do yesterday? They cut their quarterly borrowing estimate, which, I mean, to me, on the surface, that sounds pretty good.
Yeah, so it's a good thing. They cut it by about $55 billion. The Treasury Department, what they do is they have a forecast for a quarter ahead, and they almost always get it at least a little bit wrong, right? We all don't forecast perfectly what's going to happen. So they cut the borrowing estimate for this quarter primarily because it looks like revenue has been coming in a little bit stronger, meaning tax revenue has been coming in a little bit stronger than they anticipated, and spending has been about flat, and the fact that
we can spend more.
well, that's maybe that's part of it, but it does mean that deficits are going to be running a little bit lower than we initially anticipated. It was pretty close to our estimates. We were actually a little bit lower than that. We were one of the lower people within the consensus. A lot of people thought that they were going to be around $800 billion in net borrowing. We thought it would be under, closer to 700. It kind of came in the middle of that. So that means that the Treasury Department probably won't issue as many T-bills as we thought, but they still, we think, will increase the amount of 2-year notes, 3-year notes, all the way out to 30-year debt, issue a little bit more of that, because right now they're issuing a ton of T-bills compared to how much they're issuing of other debt. And there's only so much appetite that's going to be out there for short-end paper, especially once the Federal Reserve gets going and starts to lower interest rates.
And Ira, just on these auctions, remind us again, like, who's buying this stuff?
So it's mostly domestic investment funds. When you look at Treasury auctions, like last week we had the 5-year and the 7-year. So you have investors who are just saying, okay, look, we're not going to buy the 7-year. The 7-year went terribly. Excuse me, the 5-year went terribly. The 7-year did okay, because I think people are preparing themselves for the Federal Reserve cutting interest rates, and usually longer-term debt does better when the Fed's cutting interest rates. So you have people going out and buying that. Look, savings is still high. There's still relatively high savings rates compared to what we had, a decade or so ago. So there's still people that have money to put to work, and with interest rates closer to 4% instead of 0, treasuries are an attractive option instead of buying maybe riskier assets that have the chance of default, maybe if revenues slip or profitability slips because you think that there's going to be a recession, then you rotate out of other fixed income instruments into treasuries and also just put your incremental savings into treasury securities.
All right, put on your politics hat. You guys in the treasury markets, you must game all sorts of things, like if there's something unexpectedly happens in the election that your candidate doesn't win, but the other guy does. Have you gamed that? What are all the different possibilities?
Yeah, it's interesting because the conventional wisdom might be that if there's a Republican in the White House and Congress, that maybe they'll be somewhat more fiscally responsible. That actually historically has not been the case. That typically when you have one party that controls the White House and both houses of Congress, deficits go up. Right? Democrats spend more money, Republicans cut taxes, but both of those have the same net effect of increasing budget deficits and increasing the amount of treasury supply that needs to come out. And quite frankly, there's probably very little at this point over the next year or two that can be done to quell the $2 trillion-ish of deficit that's coming, regardless of who's in the White House. Our expectation, I think the most important thing that's going to come out of this election is not even the fiscal stuff. It's really who's going to be the next Fed chair, right? If Joe Biden wins the presidency again, maybe Jay Powell will be reappointed. I think that's pretty unlikely if Donald Trump or another Republican were to win the White House, that Jay Powell would wind up staying in his seat.
I mean, we have to remind everybody, Jay Powell was Donald Trump's pick.
Right, and quite frankly, when that came out, I was pretty surprised that Donald Trump picked him because Jay Powell is kind of a mainstream Federal Reserve governor, or was at the time. I had expected Donald Trump to pick someone who would be more definitively dovish than a mainstream economist or mainstream person. I can't call Jay Powell an economist, but nonetheless, the next Fed chair might be the most important thing from a treasury market and from a rates market point of view that's going to come out of the election cycle. So who do people say might be their pick for Fed chair might be one of the more interesting things that comes out of the election. If people are asked that at a debate or in a town hall or something like that, I would certainly be interested to know, is Jay Powell likely to be reappointed, or if not him, then who else?
But I always thought, my conventional wisdom was that, the president makes the pick on the advice of pretty much everybody on Wall Street, because if he gets that wrong, you can just kiss your you-know-what goodbye.
Yeah, but there are a number of people who I think Wall Street would be okay with, but there's people along the spectrum, right? Like, if you chose someone like Lyle Brainerd over Powell, then you get a slightly different outlook on there. Governor Waller versus Jay Powell, again, like you'd have just some nuanced differences in the policy outcomes that you might actually get, just because those people have different opinions. So if you wind up with you go through a whole slew of former governors or former Federal Reserve regional Fed bank chairs, like James Bullard, for example, is out there, and he might have even a different take, and might be more hawkish or dovish than some of the other potential picks. So, and I think all of those, if they're known quantities, could probably Wall Street would probably be okay with them. It's just a matter of what price level you
right.
get. If you pick a more hawkish person, then maybe stocks go down, but it's not that the market's not going to function, and it's not that the Treasury market is suddenly going to implode because you picked one person who was more or less a dovish mainstream person or a hawkish mainstream person.
All right, Ira, great stuff as always. Really appreciate you checking in with us. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, UPS had some disappointments, as Nora was just reporting, laying off some people. Ben Elgin, Bloomberg News, has got a great story out today. FedEx, UPS struggle on EV transition as delivery demand grows. Costly electric trucks and charging complications are hampering progress. I didn't even think about that. Like, they got to go electric too, and if they can't get the trucks and all that kind of stuff, how are they going to get that package to me in 15 minutes?
They're going electric because it's good for the environment, or they're trying to save money?
I don't know. Let's check in with somebody who actually, we pay this guy to think about this stuff. Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst, one of the best on the street. We got him at Bloomberg Intelligence. He's down from our Princeton bureau. Hey, Lee, first let's just start with the news at UPS. I love UPS. I love the brown trucks. They deliver this stuff great. What's going on? The stock hasn't done much in a while. I know they've got some union issues, which they resolved earlier, and now they're laying off some people and forcing everybody to come back to work. What's happening at our good friends at UPS?
Yeah, I mean, they're really just reeling from the impact from the labor negotiations they had last year. So running up ahead of those negotiations, a lot of shippers were like, you know something, I'm not going to use UPS because I might want to use one of their competitors like FedEx or even the Postal Service, because I don't know if my stuff is going to be able to get where it needs to go on time. So a lot of that diverted freight, is kind of deleveraging effect on the network, which really weighs on margins. And then, they had the negotiations. They have a contract in place, which is fantastic for UPS and also for the Teamsters. But a lot of the initial costs of that new contract are in year one, and so that's like a real big hit to margins. That, coupled with the fact it's taking some time for them to win back some of that share. On today's earnings call, management noted that they've won back about 60% of that share. So it's going to take time for them to get that share back to where it needs to be. And again, these are networks, and when you're talking about freight transportation, it's all about building density, because the more stuff you can deliver at the same time, the better the margins are. And that's what they're really working through right now. What I thought was kind of one of the more interesting little tidbits in the call this morning is that they think that this year that the small package volume from an industry standpoint is only going to increase like 1%, which to me I thought was a little pessimistic. But all in all, they're really dealing with tepid demand. They're dealing with rising costs, and they're obviously taking those costs pretty seriously, as you mentioned earlier. They're laying off or planning to lay off or reduce heads, however nicely you want to say it, 12,000 people, and then also they're looking to get they're putting their brokerage business, which is called Coyote, under a strategic review. Coyote is the third largest freight broker out there. So one of the largest publicly traded ones are C.H. Robinson. People might not know that, may know that name. Also, RXO is another pure play brokerage, is Landstar. There's a couple private ones. A lot of large companies like J.B. Hunt have their own brokerage business in-house.
Sorry for a series of stupid questions, but this
Sure.
is who you're talking to. What is a freight? What's their role in? What do they do? A freight brokerage?
So they're pretty much get together buyers and sellers of freight. So if you think about it, so if you're a shipper and you have a load that you need to get from point A to point B, you might use a broker to find a truck to carry that load. And the broker kind of makes a spread in between what they're charging the shipper and what they're paying the trucking company. What's happened is, it's a very cyclical business. There's great highs and kind of depressing lows, and margins can be very volatile during this cycle.
So this just to back up, this brokerage that they own, that they're now getting rid of, you could have gone to them and they could have picked a shipper other than the company that owns them, UPS.
Yeah, so UPS could potentially use its own in-house brokerage to move a trailer load of freight between two of their sorting facilities. Or if you're Walmart and you have an extra load that you need to get from your DC to your Spring Lake Walmart. I don't think there's a Walmart in Spring Lake.
Brick Township.
You might use them because either the carriers that you're contracted with don't have the capacity, or you're trying to take advantage of cheap rates in the spot market. And right now, truckload rates are extremely cheap. They've been bouncing along the bottom for quite some time, and so shippers might like to leverage that. Intermodal is an example. So the intermodal space, which is railroads, That's when you see like 2 containers on top of a railroad. They're facing increased competition because of the loose conditions that are in the spot market, and a lot of those shippers might use brokerage to try to find try to find a carrier to carry their loads.
I think in there it sounded like you just said there was a freight recession, or at least implied
I've been calling that for a long time.
Okay.
Well, there has been for about 2 years now.
I mean, how severe is it right now?
The way we look at it, we're probably a little optimistic about 2024, kind of a glass half full, and it's filled with a really good Cabernet. So I'd say we're probably more optimistic than most. We've been saying that we didn't feel that the economy necessarily had to go into a regular recession, and just because you go into a freight recession doesn't mean it's going to lead into a regular recession. The freight recession is really driven by a number of things. First and foremost is they had really difficult comps during the pandemic. You were talking about trying to get a refrigerator. Everything was just gummed up during the pandemic, and so capacity was in high demand, and the problem with getting capacity was that there weren't enough workers to either be in the trucks or be on the railroads or be in the air freight area. So there was a real issue there, and so we just saw like a backup in demand, and then all of a sudden that demand got fulfilled because supply chains started loosening up. Here we are today. You have moderating economic demand. You have an ISM in negative territory, so the manufacturing economy is not great. You have some difficult comparisons. So when we look at railroads, for example, not to be all over the place, but when you look at railroads, last year was a fantastic year for Canadian grain. This year is going to be a normalized crop, so that's a decline in volumes that the railroads are going to have to deal with. Railroads at Canadian Pacific and Canadian National. Automotive is expected to be strong this year, continued for the railroads, but coal is probably going to be weak because the export markets are probably going to start to cool, and they have some really serious difficult comparisons. And intermodal is really a crapshoot. We're pretty optimistic about the domestic demand, which is more truckload competitive, just because the rails have gotten a lot better at improving their overall service. So we started talking about UPS, and somehow
now we've got all across logistics. See, that's because Lee covers the railroads, he covers the trucking companies, he covers the logistics companies, he covers the shipping companies, like big ships on the seas, and he covers it all. So we just call him basically logistics analyst. I mean, if you got to get a box from point A to point B and you want to know how to do it, you talk to Lee Klaskow.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I don't know what to do with this market because we had it just rip there in the last couple of months of 2023 on that Fed pivot. We've had some pretty solid economic data so far this year. The earnings, okay. We'll see with some of the big tech companies this week. But the question is, where do we go in 2024? So let's check in with somebody who does this for a living. Nimrit Kang joins us. She is the Chief Investment Officer at North Star Asset Management, joining us via Zoom from the town of brotherly love, Philadelphia, PA. I'm a huge fan of Philly. Nimrit, thanks so much for joining us here again. I don't think a lot of people kind of saw that move higher in stocks, in bond prices at the end of last year. Maybe some people thought that pulled some of the performance from 2024 a little bit forward here. So as we finish out a pretty solid January here, Nimrit, what are you telling your clients for 2024?
Yeah, we tell our clients to focus on what they know with a lot of certainty. What we've seen in the last 2 years, Paul, is a round trip, right? Last year was a pretty strong year for the markets, but it was on the heels of a pretty dismal 2022. So we really did a round trip here in the last 2 years. And, when we think about broadly for our clients, we expect to be in this era of heightened uncertainty and volatility in the financial markets. We are coming to a reversal of several big trends that have been in play for a number of decades almost. The big one is the monetary cycle reversing. So in this environment, we just want our clients to remain focused on what they know with a lot of certainty, which is understanding and clearly communicating what their financial needs are going to be over the next 5-10 years, and then setting appropriate strategic asset allocation based on that.
Okay, with a monetary cycle reversing, first of all, what's your expectation for the Fed? The two-day meeting ends tomorrow.
John, as much as I would like to kind of speculate what the Fed is going to be doing and how exactly they're going to say, we take a little bit of a longer term view, and we do think there's an upward pressure on the rates, right? I mean, we do have record deficits going on, record debt, and at the same time, our governments have to grapple with some of these big societal, ecological challenges. So there's this continued upward pressure on spending, aging demographics. If we take all of that into account, we do think that, the 10-year between the 4 or 5% range is a more normalized kind of an environment going forward. Now, within that range, it fluctuates all the time based on every single word out of the Fed about the speculation on what their next move is going to be. Just in 2023, I was looking at the data. The low point for the 10-year was a 3.3, and a high point was 5%. That's a big move for what's usually it's a very stable asset class, right?
Yeah, it is. It's interesting. And one of the things I was thinking about, when putting a portfolio together for 2024 is on the fixed income side. I was so surprised that the best performing fixed income category in 2023 was high yield bonds. How do you think about high yield bonds in this environment when it looks like we're going to have rates coming down?
We take a little bit of a differentiated approach. So on the credit side, we want to be in very high quality bonds, where basically there's a contractual obligation to get the money back. And we take more of the credit or company risk really on the equity side. So that's how really we think about it. On the bond side, we prefer to construct a very laddered portfolio, diversified across maturities, but really in very high quality government guaranteed debt.
Ooh. Nimrit, are you 60-40 or have you changed those allocations?
Yep. John, the allocation really depends on every client and their individual needs and their investing horizon, right? So we do think that equities have a very strong role in the portfolio as long-term capital appreciation. We do think fixed income here is providing a pretty nice yield income here for a lot of people who are looking for that part as well. But the actual allocation depends on where the clients are in their journey.
So, my friend here, John Tucker, he started 2023 long and overweight, the Magnificent Seven. He's just doing this radio thing because he loves it. The rest of us have to work on our portfolio in 2024. Do I chase those big tech names? And again, we're going to see a lot of them start reporting earnings tonight. Do I chase them, or do I just say, missed that boat? Let me go look at maybe a sector that's not participated?
Paul, our approach is to really identify these long-term companies that are solving some of the secular problems and stay invested in them, take opportunities like the market volatility to really size the position appropriately. So, you talked about the Magnificent Seven, not all seven of them, but, for a very long time, we have held on to some of the holdings in there from the technology because we saw them playing a very vital role in solving some of the problems, mainly related to empowering small businesses, communities, entrepreneurs all over the world. Now, when we think about, the sectors that have run up, yes, technology has far outperformed. On a 2-year basis, though, believe it or not, Magnificent Seven, just on a 2-year basis, is up only 14%. So not as ridiculous as it seems just based on 2023 data. But that said, we do think there are plenty of opportunities elsewhere in other areas as well to continue to tilt the portfolio towards those types of compounders as well.
I want to get to some. Can you do individual names?
Yeah, absolutely. So one of the, area that we think there's a long-term secular problem is related to water. There's a huge issue around scarcity of water resources, but even just in the US, our water infrastructure was built in the 1950s and 60s. So there's a huge need to upgrade this water infrastructure to make sure that we're getting the safe quality drinking water that is so essential. Just EP estimates there's 700 billion of investments needed over the next 20 years. So when we have thought about that, we have tried to get exposure to a number of companies that play a very important role across the water infrastructure value chain. So specific names like Xylem. Xylem is very prominent in valves, meters, things like that.
What's the ticker symbol?
XYL.
XYL.
Okay.
Yep. And it's, Xylem especially has a big market position, leading market position in wastewater treatment. Again, a big area of long-term growth and where we think there's major societal problems that need to be solved. Another name, a small cap, only 700 million in revenues, is Badger Meters. They make your utility meters. There's a big upgrade cycle going on from upgrading that manual meter that needed to be read to more of those smart meters, which can be read remotely. So that's another small cap company, long-term tailwinds. The company just reported excellent 2023 numbers, double-digit revenue earnings. Going forward, we don't expect them to have that kind of a growth, but high single digit through the cycle is a pretty reasonable expectation. And the last one I'll leave you with is Veralto. VLTO is the ticker symbol. It's a spinoff from Danaher, very high quality company. 60% comes from water quality type of businesses. They analyze the water quality coming out of our streams, rivers, but also have treatment solutions such as UV filtration, some of the other treatment solutions as well. So again, these are the companies that haven't kind of had the rip-roaring returns we have seen from some of the household names, but long-term, very important demand for their products and solutions.
Not the sexiest names in the world, Paul.
No, but those work. I mean, so when you identify a theme like water, for example, Nimrit, do you and your team, do you screen across the sector for valuation, sales growth? How do you then identify individual names once you've identified a theme?
Exactly. So one of our themes in our portfolio is just related to ecological limits, right? We've had years and decades of extractive growth, and we think that's, our natural resources are scarcer, and we're going to have to learn to cope with these problems. Water falls under that. We identified that a long time back. And knowing that, then we're looking for high quality compounders within that are solving for that, solving that particular problem. And when we talk about high quality compounders, Paul, it's your traditional companies that have strong balance sheets, revenue growth, free cash flow margins, good deployment of capital, good management track record, all of that same kind of criteria there. On valuation, we take a longer 5 to 10 year view, and we use cash flow based valuation to understand what is the true valuation based on the earnings potential of a company like that.
Hey, what's the number one thing on the minds of your clients?
When we talk to clients, again, it's different, but it's really around understanding that, yes, we just live in this era of a lot of uncertainty, heightened volatility. Last year, this whole thing around AI really magnified and gave a really new leash to life for these magnificent 7 names. But longer term, our investors, our clients are concerned about making sure that they have their financial assets can help them meet their financial needs and goals, right?
Yep.
And taking a balanced approach and a very risk-aware approach towards constructing those portfolios for them.
All right, that's how the pros do it. Nimrit Kang, thank you so much. We appreciate it. As always, Nimrit Kang, Chief Investment Officer, North Star Asset Management.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk UK stocks. Let's talk European stocks. We don't do that as much here, but we can do it today because Tim Craighead is here. And Tim Craighead is a European equity strategist for Bloomberg Intelligence. He joins us live here in the Bloomberg Interactive Broker Studio. That's important because he's based in London at the awesome Bloomberg European headquarters.
I have never been.
We got to get you over
You
there,
got to
dude.
go.
It
is super cool.
Yeah, it is just awesome. I mean, and what I like about it, it's just a phenomenal building in the city of London, right by the Bank of England. But when Brexit happened, Mike was over there with the mayor of London saying, no, we're doubling down on London, which I thought was very cool because up until Brexit, a credible argument can be made that London was the world's financial capital vis-a-vis New York. A credible argument after a couple of pints at the local pub, and you could make that argument. Now you can't.
All right, remind me before he leaves, I got to ask him about congestion pricing.
Okay, very good. All right, Tim Craighead joins us. Hey, Tim, just give us a sense here. Let's start with the UK here. How did the UK trade last year? How did that market perform, and what's the expectations for this year?
So the UK did the same thing last year that it did in 2022, interesting enough, which is a big fat nothing. And if you think back in 2022, that was good. A stellar performance. Yes. It was a hero. 23, not so much, especially with the rally at the end of the year. So far this year, pretty much, again, it's sort of status quo. And our view is that's kind of where we're stuck. It's a funny thing. The UK market has this very odd composition where you've got this big basic material commodity base. You've got metals and you've got oil. Mm-hmm. You've got a big defensive brand base of companies like Unilever and Diageo, I think whiskeys, mm-hmm. And healthcare, pharma, with GlaxoSmithKline, AstraZeneca. And then you've got a big dose of financials with the big banks like HSBC. Those three, you always end up with a driver that's good for one, but bad for the others, or vice versa. And quite often, they just sort of nix each other.
Because you don't have that technology thing, which is actually the leader of the U.S. market.
The entire TMT group. So you take internet and tech and the good media, e-commerce, the whole kit and caboodle, about 1% of the UK market.
What was the best performing stock, individual stock?
Rolls-Royce, if memory serves correct, which is...
This is the engine maker, not the car thing.
The engine maker that feeds into the rebound in commercial aerospace and defense.
And the cool thing about Rolls-Royce is like each of their engines has had a name.
Really?
Yeah, well, going back to like World War II.
Okay.
The Merlin.
The Merlin, probably the most
P-51.
famous engine there ever was. They stuck that in... Well, the Spitfire, I digress, and then the P-51D Mustang, and made it the greatest plane in the world.
Yeah, absolutely. Still my favorite fighter plane, the P-51. All the Spitfires right there. F-14 is number 3. All right, Tim. I actually think about this stupid stuff. We digress and digress more. How about Europe here? A little bit broader kind of markets in terms of the weightings here. How are your clients looking at the European market?
So the European market is reasonably well positioned from the standpoint of a diverse sector base. It still doesn't have the technology opportunity set that
SAP,
the US does.
AM.
You've got basically 4 big tech companies there. If you think about it, 5. One is SAP. Yep. We all know that.
Love them.
And it's doing fine. Look at its earnings. Look at its stock price here as of late. It's been a really good call. That's one. ASML, which is chip manufacturing equipment. Absolutely a must when it comes to making things for, say, NVIDIA with their chipset. You have to have ASML's equipment. And then you've got semiconductor companies like Infineon and ST Micro. And they feed into more energy transition, autos, industrial applications, things along those lines.
But wait, tech in Europe, I want to lose weight. Isn't that where those weight loss drugs come from, or initially?
So that's Novo Nordisk,
Yeah.
and obviously Lilly is coming up as a big second here. But the pharma industry, business is a big business from a European perspective, no doubt. You've got really big consumer franchise. You've got luxury goods. And one of the bigger businesses over there that is different from here is the big high-end luxury auto companies, which are a big play on China. Another difference with Europe versus the U.S. is China is really important over there. I mean,
big buyers of the big German industrial equipment and things like that.
And it's pervasive. The UK has a ton of. It's actually the most exposed because you've got companies like Rio Tinto and Glencore, the big metals and mining that feeds in. But you've also got the autos. You've also got the industrials. You've got the luxury goods, and all of that adds to roughly a 450 billion euro revenue business from Europe selling to China. What happens in China matters a lot for Europe, which is a different story than what you have here from a U.S. perspective. You add all that together, Europe is okay. It's a lot cheaper from a multiple perspective than the U.S., but the earnings growth expectations for this year and next year are not as robust as they are here in the U.S., and it holds it back.
Do I have to worry about things if I'm a U.S. investor looking to invest in Europe? Do I have to worry about things like the currency translations, et cetera?
Well, you do, and it's kind of typical with currency as a double-edged sword. I think the conventional wisdom this year is if the Fed cuts early and first, then you've got a weak dollar scenario to be told. Now, if you're a U.S. person and you're buying European markets, let's say all else being equal, that's going to be good for you because you're going to be carrying, Europe over to here, which is a stronger currency. It actually ends up being negative for the European companies themselves from an earnings translation basis, but it's a different argument.
All right, Tim, you've lived in London a long time. You live just outside of London, so we'll get to congestion pricing. The economy here in the U.S. is good. We had a great GDP print. Inflation's coming down. How's the economy in the U.K.?
Yeah, actually, it feels a lot better than necessarily what the headlines might suggest. I think there are signs that housing prices are possibly stabilizing, certainly like everywhere else. If you end up seeing interest rates coming down and the expectations are for the Bank of England, as well as the European Central Bank to be cutting, then that could be a good thing as well. But big election cycle this year from a UK perspective that's going to cause a lot of noise, just like it is here in the US. On the ground, you're traveling, you're looking around, you're going places.
Which you do.
It feels
He does it by bike, though. All right, go to your congestion pricing, because he might not be the right guy.
And everybody should care about this. London did it first, where cars coming into the central part of the city to reduce congestion are charged a fortune. New York City is trying to do that. But all sorts of... are you a fan or like...
Whether you like what I'm going to say or not, I guess we'll see. I am a fan. I think it is a good thing from the standpoint.
But he rides his bike to work every day.
Yeah, I cycle.
And not like a mile. He rides like a long way in all kinds of weather.
But it is a case where between congestion pricing, and they are expanding that congestion zone, as well as increasing things like cycle lanes and other elements of public transport, it is an easier place to get around unless you want to drive.
I don't have a choice, though.
See, we're going to get
Well,
John,
I'm going to take my bicycle at 2 o'clock in the morning from New Jersey.
And come through the Lincoln Tunnel. That's what
but you don't have to worry about it.
No, we're going to work with somebody we know and get so John can expense his congestion pricing. I think I know somebody who can help out with that. Tim Craighead, thanks so much for joining us. Tim Craighead, European Equity Strategist. And by the way, he's also the Director of Research over there in Europe, so doing lots of stuff.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.